What's up, everybody? Welcome back to another episode of Economic Events. Today I'm going to be reading an article from themotleyfool.com. Nvidia's 10-for-1 stock split comes with a warning. History says the artificial intelligence stock could do this next. Nvidia's 10-to-1 stock split has raised concerns among investors as the company's shares have historically declined following past splits. Despite Nvidia's dominance in data center, GPUs, and AI chips, with a significant market share in a robust computing platform, the stock's performance post-split has been negative, with an average of 23% drop in the following 12 months. I'll get to those numbers a little bit more in just a minute. Analysts expect Nvidia to grow earnings per share at 31.7% annually over the next 3 to 5 years, making its current valuation appear high. However, the company's full stack strategy and economic moat, particularly in proprietary CUDA ecosystem, provide a strong competitive advantage. Investors face a challenging decision given Nvidia's current price to earnings ratio of 75.8, which translates to relatively high PEG ratio of 2.4. While the stock may seem pricey, the forecasted growth in AI hardware, software, and services projected to compound at 36.6% annually through 2030. Potential for Nvidia to match or exceed this growth rate. As such, the current valuation could appear justified in hindsight. Despite the historical post-split declines, Nvidia remains a key player in AI, and some analysts like Joseph Moore of Morgan Stanley recommend maintaining exposure of the stock due to its leading position in the AI sector. So I do have some concerns as well with Nvidia stock currently. The price being at its current rate, of course after the split, it's looking more appealing, but that's just because the price is lower. The value didn't drop, and market cap didn't drop either. So it's just it's not 90% off like some fake gurus thought it was, and they thought it had dropped so much. It's not. No panic there. But their PE ratio of, like I said, 75.8 is really high. Ideally, you want to be between 15 and 30. If you're in there, it means you're in a good position as a company. Your growth is good, consistent, solid. It's not overpriced, any of that. So the way you break down the PE ratio is if the price of the stock is $100 a share, but they're making $5 a share, then you divide the 100 by 5, and that's how you come up with the PE ratio. So that would mean this company A, priced at $100 a share, with an earnings per share value of $5 would be, their PE would be 20, which is right where you want to be. That's typically where most value companies lay at. Now, of course, with Nvidia, they're more of a growth company at this point. I mean, of course, it's crazy to say that despite the fact that they're, at the time of recording this video, over $3 trillion in valuation. But you see what's going on with the numbers and the expectations of 31% growth annually, appreciation. Basically, if it stays at this 31.3% annual return, then that means every 3 years your stock is doubling if you don't, with the appreciation of the dividends, letting them reinvest into it and all that stuff. So that's actually really good. But I'm still concerned with the high PE ratio. The mathematics don't line up. If you look at historical, and I know we're living in crazy times where GameStop's going from $5 a share to $500 a share in 2 weeks. That's weird times we're in, but we still want to look at the fundamentals. I'm a big fan of the fundamentals. That's what keeps everything insane, right? It keeps everything sane. Right now, the stock market's insane. In fact, the overall return of the S&P 500, whatever it is, I think it's currently at the time of recording this video, it's at about an 8% return. They're about a third of the returns from the S&P 500's total 8% that has been so far has been Nvidia. Now that's a lot of dead weight that Nvidia is carrying around, and That's to me not sustainable. I mean, it seems like you probably would be better off. Again, this is not financial advice. I'm not your financial advisor. This is not legal advice. But it seems like you probably be better off just putting your money into Nvidia and just letting it ride. It's what what it sounds like. Of course, these are expectations and numbers coming from the company. Any company is going to make their numbers sound good in the future. So keep that in mind too. But I'm going to go ahead and break down what happened historically with Nvidia's past returns on stock splits. So I've got that. So the first one was in June of 2000. 6 months later, they were down 50%. 12 months after their split, they were up 28%. And 2 years after that, they were down 52%. Then you're talking about September of 2001 was their first one, or their second one. 6 months after that, they were up 44%. 12 months after that, they were down 72%. 24 months after that, they were down 49%. Huge drop off from the initial stock split. Now, the stock split number 3, back in 2006, April, 6 months later, they were up 63%. 12 months later, they were up a measly 1%. And 24 months after that, they were down 6%. Now, of course, that tied into the Great Recession, as they were calling it back then. I'll get to that in a minute with the next time they split. So the next time they split, which was their fourth time, was in September of 2007. They were down 45% 6 months after the return, or 6 months after the stock split. 12 months later, they were down 70%. 24 months after that, they were down 53%. And the previous stock split before the recent one was in July of 2021. 6 months later, they were up 30%. 12 months after that, they were down 4%. And then 2 years after that, they were up 145%. And if you accumulate all that together, which I did for you, so I know that was a lot of numbers I threw at you, other than my mathematicians out there that are keeping up with it. The rest of us, we're probably confused. So I've got the average there too. So overall average, 6 months later, you get an 8% return. 12 months later, you lose 23%. And then 24 months after that, you lose 3%. So just to keep that in mind for yourselves. Again, these past results are not an indicator of future results. So what I want you to do is look at the past results and look at the future expectations and make your decision there. It's up to you if you're feeling comfortable with putting money into Nvidia. If you think that, the previous split history is not looking good for me, I'm going to hold off on that. That's completely up to you. I highly suggest you definitely do your own research and go from there. As always, I hope you all enjoyed this video. Remember to like the video, subscribe to the channel. When you do subscribe, hit that little bell that's next to my name. That way you get notified every time I post a brand new video. I do appreciate the comments that come in, the likes that come in. I don't always get a chance to reply to all of the comments, but I do read them nonetheless. They are enjoyable. So I appreciate the commentary banter. I'm getting views from all over the world, mainly the United States, but I've got some people in Europe, Asia. It starts, there's I think 1% or less than 1% of my viewers is from Russia. So shout out to the Russians for watching my videos. So I'll catch you all in the next one. Bye.